Welcome to Luck Scout Economic News and Strategies. Listen up because this matters. This isn't just another economic update, it's a crucial piece of information that could affect us all. The Empire State Manufacturing Index just dropped. This isn't a minor blip, it's a significant shift that demands our attention. It's a key economic indicator, folks, one that economists and analysts watch closely to gauge the health of the manufacturing sector. Think of it like a thermometer for the manufacturing sector. It measures the temperature of factory activity, giving us a snapshot of how things are going. It tells us how hot or cold the factory floors are running. When the index is high, it means factories are bustling with activity. And right now, things are looking chilly. The drop in the index suggests a slowdown, which could have ripple effects throughout the economy. This isn't just about some abstract numbers. These figures represent real-world conditions that affect businesses and workers alike. This index translates directly to real-world impacts. When manufacturing slows down, it can lead to job losses and reduced economic output. A strong manufacturing sector means jobs, production, and economic growth. A weak one? It can spell trouble for the broader economy. Well, that's a whole different story. A decline in manufacturing can lead to a cascade of negative effects, from reduced consumer spending to lower business investment. We're talking about the backbone of the economy here. Manufacturing is a critical component that supports many other sectors. When manufacturing sneezes, the rest of the market catches a cold. So, yeah, pay attention. This isn't something we can afford to ignore. This index is a big deal. It's a barometer for economic health, and right now, it's signaling caution. This isn't the time to bury your head in the sand. Ignoring these signs could lead to bigger problems down the road. We need to face the facts and make smart decisions. By understanding these indicators, we can better prepare for what's ahead. Stay with me, and I'll break it all down for you. Together, we'll navigate these economic waters and come out stronger on the other side. The latest numbers are in, and they're not pretty. The Empire State Manufacturing Index plummeted to negative 6.6 in July. Remember last month? It was sitting at negative 6.0. That's even worse. Any reading below zero means contraction. That's right, the manufacturing sector is shrinking, not growing. This isn't just a blip on the radar, people. It's a trend, and it's heading in the wrong direction. What's driving this decline? Inflation, rising interest rates, and global uncertainty are all playing a part. Businesses are hesitant to invest, consumers are tightening their belts, and the manufacturing sector is feeling the squeeze. Ignore this at your own peril. The market is speaking, and it's telling us to proceed with caution. Don't think for a second that this is just a manufacturing problem. The issues we see on the factory floors are just the tip of the iceberg. When factories slow down, the pain spreads throughout the economy. It's a chain reaction that affects multiple sectors, creating a ripple effect that can be felt far and wide. Think about it. Fewer orders for manufacturers mean less demand for raw materials. That hurts suppliers, who then have to cut back on their own production and workforce. Less production means fewer goods to ship, impacting transportation and logistics. Truck drivers, shipping companies, and even warehouse workers feel the pinch. And of course, fewer jobs in manufacturing can ripple out to the service sector. Restaurants, retail stores, and other businesses that rely on the spending power of factory workers also suffer. This is how a slowdown in one sector can snowball into a broader economic downturn. The interconnected nature of our economy means that no industry is truly isolated. The stock market is already pricing in this risk, with major indices down from their recent highs. Investors are wary, and the uncertainty is palpable. Don't wait for the bottom to fall out before you act. Proactive steps can help mitigate risks and protect your investments. Now is the time to reassess your portfolio and make sure you're positioned for what could be a bumpy ride. Diversification and a focus on resilient sectors can make a significant difference. Consult with financial advisors to get a clearer picture of your options. They can provide insights and strategies tailored to your specific situation. Remember, economic downturns are part of the cycle. Long-term investment strategies often weather the storm better than short-term reactions. Historical data shows that markets do recover, even if the path is rocky. Staying informed and prepared is your best defense. This isn't just about numbers on a screen or abstract statistics. This is about real people, real jobs, and real livelihoods at stake. When the manufacturing sector contracts, people get laid off and communities suffer. Think about those factory towns, where manufacturing is the lifeblood of the entire community. These are the folks who feel the pain first and feel it hardest, day in and day out. And it's not just blue-collar jobs at risk. White-collar jobs are affected too. As manufacturing slows, so does demand for accountants, marketers, and other professionals who support the industry. The economic anxiety is palpable and widespread. People are worried about their jobs, their savings, and their futures, uncertain of what comes next, and they have every right to be deeply concerned. So, what's an investor to do? First, don't panic. This isn't the apocalypse. But it is a wake-up call. It's time to get defensive with your portfolio. That means taking profits where you have them and reducing your exposure to riskier assets like growth stocks. The days of easy money are over. We're in a different market now, one that requires a more cautious approach. Don't try to be a hero. This isn't the time to be swinging for the fences. Focus on preservation of capital. Protect what you've earned. Remember, there's no shame in sitting on the sidelines and waiting for better opportunities. Cash is king in uncertain times. When the economy gets rocky, you want to look for stocks that can weather the storm. These are stocks that have a proven track record of resilience and stability, even when the broader market is facing headwinds. Think consumer staples, the things people always need no matter what's happening in the market. These include everyday essentials that people cannot do without, such as food, beverages, and household items. Companies that make food, beverages, household goods, and personal care products tend to hold up better during economic downturns. These companies produce items that remain in demand regardless of economic conditions. People still need to eat, drink, and brush their teeth, even in a recession. This constant demand helps these companies maintain steady revenue streams, making them a safer bet for investors. Look for companies with strong balance sheets, solid dividends, and a history of consistent earnings. These financial metrics indicate a company's ability to sustain operations and reward shareholders, even in tough times. These are the businesses that can provide some stability to your portfolio during turbulent times. Remember, defense wins championships. In the world of investing, a strong defense can help you preserve your capital and weather the storm. In investing, it's all about protecting your capital and coming out the other side ready to capitalize on new opportunities. By focusing on defensive plays, you can position yourself to not only survive, but thrive when the market recovers. Always keep an eye on the long-term horizon and be prepared to adapt your strategy as conditions change. Bonds might seem boring, but they can be your best friend during a market downturn. Why? Because they tend to move inversely to stocks. When fear grips the market and stocks sell off, investors often flock to the relative safety of bonds. This can push bond prices higher, providing a cushion for your portfolio. Now, not all bonds are created equal. You want to stick with high-quality investment-grade bonds. Think U.S. Treasuries or highly rated corporate bonds. Think of bonds as your portfolio's shock absorber, smoothing out the bumps in the road and keeping you on track to reach your long-term financial goals. Gold has been a safe haven asset for centuries, and for good reason. It's a tangible asset with intrinsic value, unlike paper money, which can be printed at will. When inflation rears its ugly head, as it is now, gold often shines. That's because it tends to hold its value, or even appreciate when the purchasing power of fiat currencies declines. Now, gold is not without its risks. It can be volatile in the short term and it doesn't generate any income. But as a small part of a diversified portfolio, it can act as a hedge against inflation and economic uncertainty. Don't put all your eggs in one basket. This is investing 101, folks, but it bears repeating. Don't put all your eggs in one basket. That means diversifying your portfolio across different asset classes, sectors, and geographies. Why is diversification so important? Because it helps to mitigate risk. When one asset class is underperforming, others may be doing well. This can help to smooth out the returns of your portfolio over time. Think of it like this. You wouldn't bet your entire life savings on one hand of poker, would you? Of course not. The same principle applies to investing. Spread your bets and reduce your risk. The latest Empire State Manufacturing Index reading is a stark reminder that the economic landscape is shifting. We're not in a full-blown recession yet, but the warning signs are flashing. This is not the time to be complacent. Stay informed about what's happening in the market and the economy. Read, listen, and learn from credible sources. And most importantly, be prepared to adjust your investment strategy as needed. Don't be afraid to take profits, reduce risk, or move to the sidelines if that's what's best for your financial well-being. Remember, the market is a marathon, not a sprint. Stay disciplined, stay focused, and you'll come out ahead in the long run. Trust your gut, but verify with your advisor. The information provided in this essay is for general knowledge and educational purposes only, and does not constitute financial advice. Always consult with a qualified financial advisor before making any investment decisions. Past performance is not indicative of future results. Investing involves risk, including the potential loss of principal. Please like the video and share it with others. Thank you for watching.